As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized SEMA professional qualification and the internationally respected CGMA designation. As a SEMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the SEMA Professional Qualification, the Strategic Case Study exam. Start studying the SEMA Professional Qualification. Prepare to make an impact.
Good evening, our professional colleagues, friends of the Institute of Chartered Accountants of Nigeria, our students, ladies and gentlemen. It is my pleasure to welcome you to another episode of ICAN on Air, powered by our noble institute, the Institute of Chartered Accountants of Nigeria, that pride itself with integrity and accuracy. And I have a topic before me this evening with a guest that is ready, fully prepared to do justice to the topic. What's the topic? Revenue reporting, IFRS 15, which cut across both for professionals and students writing our exams. And I brought our way this evening a man who is vast in this field. No other person than Mr. Bolaji Osho, FCA, popularly called Senator. He is a specialist in international financial reporting standard and international public sector accounting standard, IFRS and Ifrs, and well over 2 decades in selling personal service covering capacity building, coaching, consulting, and advisory service. He rose to the position of Senior Financial Admin and Infotech Controller in Troca Holdings Limited and was the Chief Finance Officer of FKG2 Limited and Azugie Limited, an accountant with in-depth knowledge and experience in information technology as it relates to business processes. He was a business manager in the Oracle Financial ERP implementation for Lagos State government in global computerization project and has anchored several training areas in IFRS and IFSA. Currently, he is the chairman of the Corporate Reporting Board of the Institute of Chartered Accountants of Nigeria from 2019 to date, associate member of the Chartered Institute of Management, SEMA UK, Chartered Global Management Account, CGMA, AICPA, fellow of our institute, and associate Chartered Institute of Secretaries, ICSA, United Kingdom. An executive director of Skills Future Professional and IQ Strategic Advisory, both are IFSAS, IFRS, Governance and Infotech Advisory firm situated in Victoria Island. Currently director in Speedcast Nigeria Limited, formerly Aris Caprock Communication. Sincerely speaking, the guest for today is a man that is well versed, loaded when it comes to IFRS and IFSA. But today we're doing justice to IFSA, IFRS 15, which speaks to revenue reporting. I want to go on a very short break. I believe that the professionals and the students are ready. Pick your book by your side. Get your pen ready. As I come in, wait, Mr. Bolaji Osho, after this short break. Stay tuned. I'll be right back. welcome back, welcome back. It is my pleasure to get this evening our own Mr. Bolaji Osho, FCA, popularly called Mr. Osho. Good evening. A pleasure to be with us this evening.
Mr. Gwande, glad to be here and thank you for this invitation.
Yes, without wasting our time, we move straight to the discourse of today, which centers around revenue reporting, IFRS 15. Let me start this way by saying that IFRS 15 was particularly developed as a standard for revenue reporting. Please tell our global viewers why IFRS 15? Why did IASB have to change from the old standard of revenue accounting?
Okay, so thank you very much for the question. IFRS 15 was the strategic response of the IASB to the obsolescence of the legacy and already withdrawn standards. So there were a lot of gaps that were being exploited by dishonest preparers of financial statements. So those lacunas provided very good tool in the hands of those who were interested in earnings management. So earnings
Mm,
management is the predetermination of what the bottom line will be. So one very tool or one very channel of earnings management is what we call the top line. So top line is revenue. So that's the one reason why the board changed the standard. Another reason is the proliferation of the old standards. There were a number of standards and interpretation that accountants needed to master before recognizing revenue. And some of these things, some of those old standards that were withdrawn were exclusive to industries. So these two reasons, lacunas in the old standards and the proliferations of the old standards, these were in part the reason why IASB withdrew those standards and issue a one-stop shop of
mm.
authoritative references relating to revenue.
A one-stop shop was created by ISSB with IFRS 15, covering the lacuna and the proliferation of the other standard. You just said now that some standards were actually withdrawn from your last submission on the account of IFRS 15. Can you tell our viewers how many of these standards were withdrew and the IFRS interpretation were withdrawn on account of IFRS adoption?
Okay, so thank you very much for the question. Proud to 1st of January 2018, the global financial reporting community had two standards that dealt with revenue recognition, measurement, and disclosures, and about six interpretations. And I'll quickly go through them. We had what we call IAS 18 revenue, which for all intents and purposes was the mother standard to all the revenue standards, IAS 18. And then we had IAS 11, which was christened construction contract, exclusively for the construction industry. So those were two standards that IFRS 15 withdrew. Okay, we had equally four interpretations. I mean, you will chuckle. How could
Hmm.
just revenue have two standards and four interpretations? And what were these four interpretations? We had what we called IFRIC 18. IFRIC 18 was the authoritative standard for transfer of assets from customers. We had IFRIC 13, which was authoritative in customer loyalty program. We had IFRIC 15, which dealt with agreement for the construction of real estate. And the fourth one, we had SIC 31, which dealt with barter transaction involving advertising services. Now, you could imagine just one standard, rather, just
Hmm.
one phenomenon, IAS 18, revenue recognition, being covered by two standard function. There is perhaps no other subject matter that is covered by or with or by as many proliferated IFRS standard as the old dispensation.
That is good. talking about two standards for interpretation. I imagine what accountants were going through preparing this. Can we continue by asking this question? Now that we understand the basis at which we migrated from the old standard to IFRS 15, can you please give us summary of the core principles of IFRS 15, at least for the benefit of our professionals here and our students in particular, who at the mentioning of Senator said they have to be part of this program this evening?
Okay, so thank you very much for the question yet again. IFRS 15, revenue from contracts with customers, is usually referred to or usually characterized as a 5-step model. What does that mean? It means every time you are to recognize revenue under the new dispensation, effective 1st of January 2018, you will need to go through these 5 steps and without exception and answer basic questions. And those questions will lead to whether you recognize revenue or you indeed book a liability if the customer had indeed prepaid you. The very first is to identify the contract. By identifying the contract, you want to establish whether a contract indeed exists between the merchant providing merchandise and the customer. Now, in identifying the contract, you go through 5 questions. Those questions you have in IFRS 15, paragraph 9. I encourage our viewers or our listeners to validate and verify this. Paragraph 9, IFRS 15. So once the questions to those 5 questions, once the answers to those 5 questions in paragraph 9 are yes, 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 then it means you have a contract. Now, before I go on, I need to quickly mention that it is not in all instances that contract must be hard-coded in a document, because IFRS 15 paragraph 10 acknowledges the fact that contract can actually be either oral or it could be documented. As a matter of fact, if you check IFRS 15 paragraph 10, it defines what a contract is. It is an agreement between two parties with enforceable rights and obligation. So the very first step in the 5-step model is what we call identify the contract. Now, the second step is identify the performance obligation. Now, under the old standard, if you recall, IAS 18 paragraph 1, revenue arose from principally 3 items: sales of goods, rendering of service, and the use by others of entities' assets. Under IFRS 15, revenue arises from the fulfillment of a performance obligation. So what's the performance obligation? They are the goods and services that the merchant promised to deliver to the customer. Now, it is important to also mention that the goods and services are characterized as assets by IFRS 15. So every and any time I mention goods and services, I'm indirectly referring to assets. IFRS 15 paragraph 31 says, paragraph 33 says goods and services are assets, even if momentarily in the case of services. So to that extent, you recognize revenue only when you transfer control of those assets to the customer. So that makes the second step. The very first step is to identify the contract. The second is to identify the obligations of the merchant, which is the goods and services to be transferred to the customer. The third step is to determine transaction price. Now, transaction price can indeed be fixed. It can be variable. I hope in the course of this conversation, I will have opportunity to further deconstruct what we mean by fixed consideration and variable consideration. Then the fourth one would be to allocate transaction price to the performance obligation you had identified at the step 2. Okay, so what does it mean to allocate transaction price to performance obligation? Now, it is not in all instances that performance obligation in a body of contract will be transferred at a time. You could have 5, 6, 7 multiple performance obligations in a single contract, which means you need to determine when each performance obligation is transferred to the customer. Some will be at a point in time, some over time. Now, those with transfer at a point in time, you are recognizing the revenue at a point in time. And then those that are transferred over time, you are recognizing revenue over time. So the last one, which is not the least, the 5th step, is to recognize revenue when and as performance obligation is transferred. So, at the risk of sounding repetitive, identify the contract, identify the performance obligation, determine transaction price, allocate transaction price to performance obligation, and recognize revenue when and as performance obligation is satisfied.
Mr. Osho, sincerely speaking, for students that will be writing exam this diet, if revenue reporting is one of the question, I can't guarantee that you've actually given an exposure to kill the question without any talk. With those principles that you have given, this will lead me to the next question. But before then, to all our viewers, our guest is here to do justice to your questions. So if you have your questions, kindly put them in. Available to read them to our guest, Mr. Osho, to do justice to them, because this is a topic that is key, strategic to every organization, because without revenue, there is no survival of that company. We'll proceed while I await the question of our viewers. Senator, can you please explain to us the whole concept of this performance obligation, which is one of the core principles of IFRS 15?
Okay, so thank you very much, Mr. Kwade. Performance obligation, like I did say a while ago, are goods and services that the entity is committed to delivering to the customer under the contract. Now, performance obligation represents distinct goods and services that the customer expects to be supplied with. Now, what that means is you can only identify a performance obligation which are assets to be transferred to the customer, or whose control are to be transferred to the customer. So you can only identify a service or a good as a performance obligation when they are distinct. Now, to be distinct must meet two conditions. IFRS 15, paragraph 27. Okay, so it means, number one, the entity can, not the entity, I meant to say, the customer can derive utility from the asset, paragraph 27A. Number two, that even from the way the entity has structured the agreement, each item of distinct goods and services are not necessarily dependent on or interrelated with other items in the same contract, okay? So I encourage our viewers to check this out in paragraph 27, 28, and 29 of IFRS 15. Now, it is important to mention that if a performance obligation is not distinct, notwithstanding the fact that it is defined or characterized as performance obligation, you cannot allocate transaction price to that performance obligation. Okay, it is important to emphasize that. So if a performance obligation is not distinct, IFRS 15 paragraph 30 says you will add it to other performance obligation until you achieve a bundle that is distinct. Now, performance obligations are usually written in contract, but there are instances where performance obligation will be implied. So the point is, it is not in all instances that you will have performance obligation hard coded into a contract. IFRS 15 paragraph 24 says performance obligation can be explicit, which means they are written in the contract. They can also be implicit. When are they said to be implicit? They are implicit if at the point of entering into the conversation or into the agreement, the entity has held itself out that it will fulfill that performance obligation. By what? By customary business practice, specific statement, or published policies. Based on one of these three implications, an entity could have implied that it will also fulfill those obligations to the customer, notwithstanding the fact that those obligations were not written into the contract. So, if performance obligations are not explicit, then it means they are implicit. Now, the point is, which is the emphasis, IFRS 15 does not distinguish between whether it is explicit or implicit. They are both treated as performance obligation, provided they are distinct, and transaction price must be allocated to them, and revenue recognized as the entity satisfies those performance obligations. I hope in the course of the conversation, we will have further opportunity to deconstruct it in addition to all that I've said about performance obligations.
Sincerely speaking, people are already making textbook with some of your explanation that you are given, doing justice to this topic on revenue reporting. And For our students who are connected and the professionals that may be having one or two things, this is the time to ask the professional who have understanding of IFRS and IPSA to do justice to some of these questions. But today, for emphasis sake, we are on IFRS 15, which is on revenue reporting. Mr. Osho, some members had sent in some inquiries, and this I want to take that you clarify between contract assets and trade receivable, because there seems to be some similarities between them. Please clear our curiosity and that of our students who are connected, and also the professionals on the table on the question above.
Okay, so thank you very much for that question. It's important to establish upfront that these two balances are balance sheets candidates. They are candidates you find in the balance sheet. And so they are assets. I mean, contract assets and trade receivable, or receivable as it were. They are assets. So that means they have debit balances. The very first clarification I'd like to make with respect to the two is the second leg to their recognition goes to the profit or loss. In other words, the second leg to the recognition of contract assets and trade receivable is revenue. Okay. So what is trade receivable? Let's begin from there. IFRS 15, paragraph 108 defines trade receivable as entities' rights to consideration that is unconditional. I take it again. Trade receivable represents entities' rights to consideration that is unconditional. And that paragraph 108 further goes to clarify that a receivable is said to be unconditional, or the receipt of a receivable is said to be unconditional if passage of time is all that it takes before the amount becomes due. So what it means is, as a merchant, you have fulfilled all righteousness. In other words, you have submitted your invoices have been approved. You are simply waiting for you to get the credit alert or for you to pick the check. And that's why it's called trade receivable. The entity need not do any other thing other than to wait out the waiting period and pick your check. Now, in contrast, or similar to trade receivable, is another phenomenon that we call contract asset. So what is contract asset? IFRS 15 Appendix A define contract asset as entities' rights to consideration in exchange for the goods and services the entity has transferred to the customer, when that right is conditioned on something other than passage of time. Now, I need to deconstruct that further. You see, when I was in employment, we had, as our number one client, British American Tobacco. BAT will engage my organization to run some projects and will give a purchase order to that effect, but with a proviso that upon conclusion of the project, we were to retire our expenditures. What that meant was we were to provide documentary evidences of all the commitments and payments that we had made. So what it means is, even if you have done everything required, but you are yet to retire, BAT will not even accept your invoice, let alone begin to process your payment. Now, imagine as at 31st December, as an entity or as a merchant, you have delivered to specification, but you are yet to retire. Of course, IFRS 15 requires that you recognize revenue for that year. Why? Because you have done all that is required. But because you are still expected to do something, what is that thing? To retire. You do not have receivable yet. And as such, you will recognize revenue, but instead of debiting receivable, you will debit contract assets. So in summary, contract asset is referred to as unbilled revenue. In other words, revenue that you have earned, but for which you are yet to send your bill to the customer. I hope that suffices. Otherwise, during question and answer, we'll have further opportunity to clarify.
You've made the clarity just very explicit for our viewers to connect. And while you're doing justice, let me especially recognize our revered past president. He chipped in something recognizing you, Honorable Senator that he cited you. You should keep up the good work. Let me proceed. That is past President Razak Jayola, who is on this call this evening. Let me quickly take Ruth Baba's question. Is asking that for an utility company, I'm sure these are the power sector people selling power to prepaid customer. When do you recognize the revenue from those cash sales?
Okay, so before answering or speaking to the question of the person that made the inquiry, Mr. President, I'm so inspired to have you here. Good evening, sir. So to the question, I did mention at the onset of this conversation that the fourth step in the five-step model is to allocate transaction price to performance obligation. And the final step is to recognize revenue when or as performance obligation is satisfied. Now, for those in the power sector, indeed, for anybody in the service sector, you will very much not likely recognize revenue, notwithstanding the fact that the customer had prepaid you. As a matter of fact, IFRS 15, paragraph 106 required that if you collected as a merchant or the provider of goods and services, if you were paid upfront by your customer, you must recognize that upfront payment as a contract liability, and then begins to discharge the contract liability to the what we call the top line in the profit or loss as you provide as you fulfill the performance obligation. Now, to summarize this intervention, it means you will recognize revenue to the degree of the power consumption, okay, by the customer. So if a customer had prepaid you, you book a liability, and as the customer, for those in the power sector, it is expected, because it's an IT intensive operation or IT intensive phenomenon. It is very, very much expected that there will be a dashboard through which the Ikeja Disco or whatever Disco can determine how much of the prepaid power, the prepaid energy had actually been consumed by the customer. And this is not limited to just the power sector. It cuts across all services, GSM. I could go on and on. So for those industry, you recognize revenue as performance obligation is satisfied. Now, there's another point I would have liked to make. I sincerely hope, but we don't have time. I sincerely hope somebody will ask a question that is tangential to it, and I'll use it as an opportunity to make the clarification.
Yeah, before I come to Mr. Lola Johnny's question, let me quickly pick up this conversation about non-refundable upfront membership fee paid by new members of social club and health club. Prior to now, the non-refundable upfront fee were recognized as revenue upon receipt. Has the practice changed under IFRS 15?
Okay, so thank you very much for the question. What I'm about to say is not peculiar to the question you just asked. It's one of the fundamental, central, cornerstone principle of IFRS 15. On no account should an entity recognize revenue upfront. I'll take it again. On no account should an entity recognize revenue upfront, irrespective of whether the client has paid or not. As a matter of fact, IFRS 15, paragraph 31 requires that you recognize revenue. In fact, paragraph 31, 32, 33 requires that you recognize revenue as you transfer control of assets, those goods and services, to the customer. Now, to your question specifically, I was providing advisory services to a popular social club on the island, and conventionally, it was the practice that when you are to join as a new member, you will need to pay certain upfront fee or joining fee, and then those joining fee were recognized as revenue on admission. Now, IFRS 15 Appendix B48, IFRS 15 Appendix B48 requires that you do not recognize those upfront fees as revenue when they are made. As a matter of fact, you must spread the upfront fee pretty much like you will spread every other fee. So what it means is you will determine if the upfront fee is a recurring decimal. In other words, do they pay the upfront fees every other 5 years? If the answer is yes, then you will recognize the upfront fee you collected in this cycle. You will recognize it over the 5 years. But if it is not a recurring decimal, you will still find a way of spreading the upfront fee over the membership, over the life cycle membership of such new members. I hope that clarifies it.
Yeah, that's I've done justice today. And to our viewers that are connected globally, I've been guesting Mr. Bolaji Osho, FCA, the man we popularly call Senator, talking to us on revenue reporting. Mr. Shegun Ayodele is asking that how is discount recognized in line with IFRS 15?
Shegun Ayodele Agbolade, thank you very much for the question. IFRS 15, okay, so let's take it this way. Discount is a component of transaction price that creates variability in transaction price. IFRS 15, paragraph 46, 47 says your transaction price can have fixed components. It can also have variable components. Okay, so if it has variable components as an entity, you need to first of all estimate the amount. Of course, you are the one granting the discounts to the customer. Discount. So you need to estimate the amount of reduction that could characterize the transaction price. Okay, IFRS 15, paragraph 53. Okay, it provides insight into how to estimate it. There are what we call most likely amounts, which is usually done if your outcome is binary. In other words, it can either be this amount or this amount. And if it is not binary, you will use what we call expected value. Now, Mr. Ayodele, you see the word discount in the context of IFRS 15 actually has many vocabularies. I'm on paragraph 51, IFRS 15. IFRS 15 also uses the terms like rebates, refund, okay, incentives, price concession, performance bonus, discounts, credits. Okay, these all create variability in the determination of transaction price. Before I hang my boots on that question, now be proud to recognizing variable consideration as part of transaction price. It is important that you subject it to constraining. Okay, I hope in other interventions I will have opportunity to further clarify what it means to constrain the estimate of variable consideration.
And that will lead me to the question before I come to Mr. Kalu on that constraint of variable consideration. Considering your unparalleled experience on this standard, which you've been doing justice to, can you speak to the concept of fixed consideration and variable consideration and what it means to constrain the estimate of variable consideration, so that we'll link it to your last statement?
Okay, so thank you very much yet again. We did say a while ago that transaction price could have fixed elements. It could also have variable elements. Okay, but before you include transaction variable consideration as part of transaction price, you need to estimate it. And it is important to give perhaps a metaphor here. Okay, so imagine you have engaged me to deliver to some briefs, to some projects, and you had commissioned me with a fixed price of 10 million USD. In other words, upon satisfactory delivery of my service or goods, I will be paid $10 million. Because that sum is certain in timing, it's also certain in amount. We call it fixed consideration. Imagine that as part of the understanding, I will be entitled to 20% of that 10 million USD as bonus if I deliver within a time frame. What it means, following the anecdote I just created, is that the transaction price has fixed component, which is the 10 million USD. It also has variable components, which is the 20% of the 10 million USD if I'm able to perform within a limited time frame. Now, IFRS 15 requires that I subject it to constraint. What does it mean? It means the standard requires that I approach the variable consideration with the mindset of conservatism, that I filter the variable consideration through the lenses of prudence concept. I should not overstate the amount of variable consideration to which I expect to be entitled. As a matter of fact, IFRS 16 paragraph 56 requires that you include some or all the amount of variable consideration as part of transaction price, only to the extent that it is highly probable that a significant reversal in the amount of the cumulative revenue recognized will not occur when the uncertainties associated with variable consideration is subsequently resolved. Now, to deconstruct that, what does it mean in simple English? It means, by all means, do not be bullish in the estimation, because I did mention in paragraph 53 of IFRS 15 that you need to estimate the variable consideration. Now, after estimating, please apply prudence in the measurements that you have estimated before including it in transaction price, so that it will eliminate the preponderances of you having to reverse the revenue already recognized on account of ambitious or audacious revenue measurement or transaction price measurement.
That is doing justice to that question on the fixed variable and what it means to constrain estimate of variable consideration. I've been guesting Mr. Bolaji Osho, FCA, who has been doing justice to this, and I believe our viewers connected globally actually benefiting from this. Let me pick on Charles Kalu question, who is saying revenue recognition of for SMEs is covered in Section 23 of IFRS for SMEs. How does this IFRS 15 affect this section of the IFRS for SMEs?
Okay, so Charles Kalu, thank you very much for that very thoughtful question. International Financial Reporting Standard is indeed the mother of many other reporting standards that derive their authority from IFRS. So I'm going to expand the question a little, Charles Kalu. I will speak to it in the context of IFRS for SME. I also speak to it in the context of international public sector accounting standards. Charles Kalu, with the fullness of time, the portion relating to revenue recognition in IFRS for SME will be revised in order to inherit the sum and substance of IFRS 15. At the moment, the IFRS for SME is a derivative, of course, a watered down version. It's a derivative of IAS 18 and some part of IAS 11. Okay, now that those standards, IAS 18 and IFRS 11, had gone into moribundity, it is just fitting to expect that the portion relating to revenue will soon, not even if, but it is when, okay, will be revised. Now that's to that. Look at this. IAS 18 and IAS 11 were also the key ingredients that led to or that provides inputs into what we call IPSAS 9 in IPSAS. IPSAS 9 is revenue from exchange transaction. Okay. If you check IPSAS 9 and IAS 18, you will see mirror images of one another. My point is, the International Public Sector Accounting Standard Board had actually begun the process of revising both IPSAS 9 and IPSAS 23 in response to the change, the phenomenal change that had happened to the legacy revenue standard, which is what led to IFRS 15. Charles Kalu, I hope that speaks to your question.
Definitely, Charles Carlo has actually picked that up, and a lot to gain from it. While we move on, Mr. Osho, I want to ask, are there uniqueness in the treatment of transaction costs incurred in revenue accounting under IFRS 15?
Okay, so in my preamble, when you had asked why IFRS 15, recall that I adduced two fundamental reasons. Number one were the gaps in the old standard, and number two, the proliferation. Now, let's discuss one of the gaps, which speaks to the question about cost recognition or cost measurement. You know, under the old standard, cost recognition was a driver of revenue recognition. In other words, if you did not know your costs, you will not recognize revenue because of matching concepts, understandably. This will had in IAS 18, paragraph 14, paragraph 14E to be specific. Now, there was also a major gap in the old dispensation. IAS 18 did not give cognizance to the fact that you could incur certain costs in the advancement of your revenue objectives that are not to be expensed. You can incur certain costs that fall within the scope of other standards, IAS 18, property, plant, and equipment, IAS 38, intangible assets, and so on and so forth. But IAS 18 just presupposes everything, okay, are to be expensed. Now, under IFRS 15, two cost elements were recognized. I'm on paragraph 91, IFRS 15. There's what we call incremental costs to obtain, okay, and then there's costs to fulfill. Now, what is incremental cost to obtain? Paragraph 92, IFRS 15. Incremental cost to obtain are the costs you incur simply because you have obtained the contract. I'll take it again. Incremental cost to obtain are the costs that you incur because you have won the contract. The standard provided a categorical example of sales commission. Organizations don't pay sales commission except they have won the contract. Okay, so the standard requires that for such incremental cost to obtain, you recognize them as assets to the extent that they are recoverable. IFRS 15, paragraph 91. Okay, the second cost element is what we call cost to fulfill. Okay, cost to fulfill are those cost elements that meet these three conditions. Number one, they are directly attributable costs. Number two, they generate or enhance the resources of the entity that will be used to fulfill the performance obligation. Number three is that they are recoverable. When those three conditions are met, they are classified as cost to fulfill. Now, what do you do to these two cost elements? Incremental cost to obtain and cost to fulfill. If I have time, I would like to talk about cost to obtain without the prefix of incremental, okay? Now, what do you do to incremental cost to obtain and cost to fulfill? You will recognize them as assets in your balance sheet. What that means is, under your current asset, in addition to contract asset, in addition to your receivable, we will have two new candidates, okay, brought about by IFRS 15, referred to as incremental cost to obtain and cost to fulfill. You are to amortize them to profit or loss over the period of the contract. Now, as I close on this topic, those two cost elements are to be dealt with by IFRS 15 to the extent that they are not within the scope of another standard. IFRS 15, paragraph 96. If they are within the scope of another standard, paragraph 96 of IFRS 15 requires that by all means, please treat them within the scope of those other standards. which essentially refers to IAS 16 property, plant and equipment, and IAS 38, or indeed IAS.
Yeah, brilliant submission by Mr. Bolaji Osho. Shuai Badmos wants to know if there is any provision in IFRS 15 for premium income recognition by insurance entity.
Okay, so Shuai Badmos, thank you very much for that good question. IFRS 15 excludes certain industries, indeed, certain potentially recognizable revenue elements. If you check IFRS 15, paragraph 5, it identifies certain instruments or certain industries that are scoped out of IFRS 15. Okay, so one of which is the income earned by financial institution, which will be in the scope of IFRS 9. Okay, and the income earned by IFRS 9, IAS 32, and IFRS 7 for disclosure, and the income earned by insurance company, which falls within the scope of IFRS 17. Shuaib, I hope that clarifies it.
Yes. Olugbenga Folorenshaw also want to know that is it possible for a revenue to be derecognized or reversed if the customer encounter natural disaster after fulfilling the 5-step model?
Okay, fantastic question. Fantastic question. Okay, so I did say at the beginning that in recognizing revenue, the very first thing is to go through a 5-step model, and the very first step is to identify the contracts. You have it from paragraph 9 to paragraph identify the contract, determine transaction price, paragraph 1 to paragraph 21. Okay, identification of contract from paragraph 9, I meant to say, paragraph 9 to paragraph 21. If I said something different from what I just said, please ignore it. Identification of the contract from paragraph 9 to paragraph 21. You see, the conditions to be met before you conclude that a contract exists, you have it in paragraph 9. And they are, number one, the rights of those two parties can be established. Number two, the contract have been approved. Number three, payment terms have been defined. Number four, the contract will have commercial substance. What that means is the cash flow of the entity selling the goods or services will be impacted by the contract, either through cash inflow or savings in outflow. The last one is that it must be probable that the customer will be able to pay. Shuaib, if I got your question correctly, at the point of the assessment, those 5 questions were yes, 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 yes. But subsequent to the initial assessment at inception, the customer experienced a force majeure that makes it impossible for him to pay. Now, paragraph 13, 14. In fact, paragraph 13 says you should not even reassess the conditions in paragraph 9, okay, except, I'm on paragraph 13. You should not reassess the condition in paragraph 9, except there's a change in fact and circumstances. So to the person who asked the question, paragraph 13 of IFRS 15 requires that if there's a change in the circumstances that crystallizes into variations of those 5 elements that I mentioned in paragraph 9, then you need to reassess. So what's the point? If the amount is irrecoverable, then you probably no longer have a contract. Please, you can confirm what I just said in paragraph 13, okay? But if you have gone too far into the soul of the contract, then the amount that is irrecoverable will be subjected to impairment, okay, based on IFRS 9, okay, using the simplified model of IFRS 9, Appendix B, Appendix 5.5.15, not appendix, paragraph 5.5.15, and Appendix B 5.5.35 IFRS 9.
Iwe. This is doing justice to revenue reporting, and I want to believe that Folorenshaw has gotten the explanation time will really not be our friend as we wind up. Let me quickly recognize this question that you give clarity on the principle of breakage in IFRS 15 and how it implies to merchants of goods and services.
Okay, so thank you very much. If I got it correctly, you pronounced it as breakage.
Yeah.
Okay, so breakage is um, um, a new vocabulary that IFRS 15 Appendix B45. In fact, it was the final word. It is the final word in Appendix B45 of IFRS 15. Another word for clarity for breakage is customers' unexercised rights. There are instances customer will pay for goods and services, and for whatever reason, they will fail to show up, okay, to collect the goods they've paid for, or to realize the service or enjoy the services they paid for. Now, IFRS 15 Appendix B45, of course, it begins from Appendix B44 and ends at Appendix B47, but primarily Appendix B45 says you recognize such breakages. Now, I don't know whether the plural exists. The standard just use the word breakage. You recognize the breakage as revenue. But before you recognize the breakage, what's the breakage? Customer paid you, and for whatever reason, years upon years, 5, 6, 7 years, they have not shown up. You may not even wait for that long. Recognize those amounts as revenue. But the standard cautioned, the same Appendix B45 caution, that guess that wait a minute, before you recognize it as revenue, please constrain that breakage. Pretty much like we discussed in Appendix B, in paragraph 56. Okay, that you should constrain it to you should constrain the amount of breakage so that there will not be a reversal of the cumulative revenue recognized when the uncertainties as to whether the customer will come back and claim his rights, okay, when the uncertainties are subsequently resolved. Okay, I actually have a classic practical illustration to drive that home, okay, but time will fail us, Mr. Kwande.
Sincerely, I've made due consultation with time all the time that I'm on this program, but it will not be my friend because it's always winding up gradually. Before I give the final shot, there was a question from one of our students. I'm sure you recognize that, hearing that you are the chairman, corporate reporting board for our institute. He's asking the question, aside the study pack, do you have any textbook that the students can have a study for in preparing for exam for corporate recruiting? You are the board chairman, and the boy is looking up to you that save me and let me go.
Okay. I am a little at a crossroad as to the true motive for the question. If the intention is to inquire if I have written a book of my own, the answer is a categorical no. Okay,
No.
if the motive is for me to recommend books, okay, that will violate the commercial objective of this platform. I imagine if any merchandise is to be marketed, such promoters must fulfill certain pecuniary obligations to the institute. So I hesitate
Uh,
to make any recommendation. However, one point that must be emphasized over and over is the fact that we all should get used to reading the standard itself. Okay, beyond the insights provided by textbooks, we should try and verify and validate these claims, these assertions by the authors from the Red Book itself. Okay, because come to think of it, what you call IFRS is a moving train. Okay, so if you had bought a book written 6 years ago, chances are that, in fact, categorically, IFRS 15 might not have been part of it. IFRS 16 might not have been part of it. The final version of IFRS 9 might not have been part of it. So from time to time, you need currency in the authoritative references for IFRS? Now, I know I might not have answered your question, but it is my hope that at least it has provided some measure of clarification that could
Sincerely
be
speaking, that
helpful.
clarification is deep, Mr. Bolaji Osho. IFRS is a moving train. You need to keep updating record. In a minute, as we close the session for today, ICANN is always open to ideas that will positively advance the growth of our members, accounting profession, and Nigerian business environment. What will be your general advice or suggestion to our institute, the members, regarding IFRS adoption and the implementation of IFRS 15 in Nigeria?
Okay, so Mr. Kwade, I am particularly inspired that you asked the question. Many years ago, I read a book written by a man called Stephen Covey. He, he, he named the book Seven Habits of Highly Effective People. Please permit me to quickly go through the 7 habits. The first habit is be proactive. Second habit is begin with the end in mind. Third habit is put first thing first. The fourth habit is think win-win. The fifth habit is seek first to understand before being understood. The sixth habit is synergize. The seventh habit is sharpen the saw. Now, Stephen Covey actually emphasized that the seventh habit is the habit that gives strength to the remaining 6 habits, sharpen the saw. What does it mean? It means as a person, you must continually renew yourself, renew your cognitive ability in your core area of competence. Now, others before him, and many since his time, have come to advance this same principle about the need to develop yourself. One of the most popular or most important American presidents, Abraham Lincoln, was quoted as saying this president was regarded for his energy and for his productivity. He was quoted as saying that if he's given 6 hours to cut down a tree, he will spend the first 4 hours to sharpen his axe. Incidentally, Abraham Lincoln was a professional woodcutter. So he must have meant that both literally and figuratively. So what's my point here? As members, we should constantly renew our cognitive abilities in financial reporting. We should step up our game and increase our capacity to provide solutions to business problems so that we can live up to the creed and the value of the certificate we carry. If we do not, we will claim to be chartered accountants, but we may not reflect the value proposition that the chartered nature of the accountancy provides. Now, for those that are asking themselves, so how do I step up my game? How do I change addresses? Okay, in this area of IFRS, how do I become a force? How do I become a specialist in IFRS? I chair a committee in ICANN called Corporate Reporting Faculty. In fact, a training program ends tomorrow. When next programs are advertised, we encourage you to make it a reality with us. Come listen and we can make experts out of you. Interestingly, Senator is a regular speaker in those programs. Now, Mr. Kwade kept humming, which means I need to cut it. And on this note, I say thank you very much.
Thank you very much, Mr. Bolaji. Your time will not be our friend, and you've actually done justice to this today. On this note, I'll be cutting it a close. We sincerely appreciate you for spending your evening with us on ICANN On Air this day, Thursday, 3rd of November. And to all our viewers, thank you for making our time for us today. And make it a